One of the factors that a company is going to consider when it's deciding whether to use short-term or long-term financing is how much is it going to cost us to use one versus the other. And with that in mind, we need to diverge a little bit, a little aside, and discuss what we refer to as the term structure of interest rates. And by term structure of interest rates, essentially what we mean is looking at interest rates on long-term versus short-term debt. We refer to the relationship between long-term and short-term debt as the yield curve. The yield curve shows the relative level of short-term interest rates to long-term interest rates. Before we go any further, just to get an understanding of why we refer to this as the yield curve, I've gone here to a Wikipedia site, looked up yield curve, and clicking on a depiction of the yield curve here. This is from February. It says February 2005, February 9th, 2005, and we see a curve, all right? And down along the bottom, I'll circle in red, the borrowing period. So we're looking at how long the life of the debt instrument is. So if you want to borrow with a 30-year note, a 30-year bond, we're out here at 30 years, and we see that interest rates in that instance are a little above 4%. Okay, right in that level. If you're interested in borrowing over a 5-year period, they were actually up at a little over 4.5. For over a 5-year period, it's more like 4%. All right, a little over 4% in that range. If you want to borrow money just overnight for the next, for the next 2 or 3 days, and banks do that frequently, well, or maybe just for a month, well, now you're looking at debt costs of only like 2%. So when we refer to the yield curve, that blue curve that you see right there is what we're referring to. And that's why we call it a curve. It shows the relationship between the interest rates paid on long-term debt versus short-term debt. We'll return to that in a moment. But let's go back here. The curve that I just showed you used government securities, and that's typically what's used to draw the yield curve. The government security, a U.S. government security, is considered to be free of default risk. The government is sure to pay you back. After all, they're printing the money, so they shouldn't run out of it. So they're sure to pay it back. That's not true of corporations, and so it's harder to gauge exactly what the cost of corporate debt is in general. It's going to be more than the government debt, but how much more depends upon how risky an individual corporation is. So corporations, corporate debt is at a higher interest rate because there's greater financial risk related to it than for the government rate. Yield curves change from day to day, meaning interest rates, both long-term and short-term, change from day to day to reflect the competitive pressures that are in the marketplace at any given point in time, what people think inflation is going to be going forward, changes in the economic environment. When there's a recession, interest rates tend to fall. When things are booming, interest rates tend to rise because there's greater demand for borrowing in those environments. So those things tend to explain sort of the term structure. Let's go back out here. What we see here is what we think of as a normal, sort of a normal slope, upward sloping term structure of interest rates, meaning as we go to the right, the curve goes up. This is sort of the norm, but it isn't always the case. There are times when the term structure becomes inverted or downward sloping, and we actually see curves that look like that, where it becomes, if you are willing to borrow for long periods of time, it's cheaper than borrowing for short periods of time. Those are rare, but they do occur. There are times when those do occur. They usually are associated with a period of when there's a expectation that the economy is going to do very poorly. Jump back out over to our PowerPoint. Let's turn to sort of the basic theories on the yield curve. In other words, these are theories about why the yield curve takes the shape that it does at any given point in time. The first theory, and the only one that really stipulates that long-term rates should be higher than short-term rates, is something that we refer to as liquidity premium theory. And essentially what this theory says is if the market for short-term securities, short-term government debt, is more active, if there's more trading in short-term securities, then it's less risky to hold a short-term government bond or treasury bill. And since it's less risky to hold it, people are willing to accept a lower interest rate on it. Longer-term government securities, 30-year securities, 29-year securities in particular, trade less frequently. There's not as liquid a market for them, and therefore it's riskier to hold them, because if you wanted to sell it, you might have difficulty selling it at any given point in time at a fair price. So the liquidity premium theory says short-term interest rates are lower because short-term bonds are less risky. There's greater ease in selling those securities, and so the liquidity premium is there's a you might think of it as an illiquidity premium. There's a premium cost in long-term debt, premium price. The price is higher. The cost of debt is lower for short-term debt. Another theory is called the market segmentation theory. It essentially says different kinds of investors buy different lived debt. Banks are prefer to lend short term, and the reason in part is because they have depositors who can demand their money back the very next day. So these demand deposits sort of force banks to prefer to lend out that money on a short-term basis. There are other investors, such as pension funds or life insurers. A pension fund may be planning for disbursements that are going to occur to people who have pensions that won't be paid for 20 years. Some people buy life insurance policies in their 20s, and the life insurance company expects that they're going to have to make payments in 50 years. They want to make investments that pay off with some certainty 50 years from now to match the liability that they have. So this is, in a sense, very similar to the matching of asset lives to debt lives that we've seen earlier. So this theory, though, doesn't suggest that short-term rates should necessarily be lower, just that they should be different from long-term rates from time to time, because the people who are supplying the capital are just a different set of people entirely. And if banks are flush with cash, short-term rates should be low. If pension plans and have relatively more cash at any given point in time, then long-term rates should be lower, as they plow more money into long-term debt to match the liabilities that they expect to have in the long term. The third hypothesis we refer to as the expectations hypothesis. The expectations hypothesis basically says that long-term rates are driven by not only the short-term rates of today, but what people think the short-term rates will be in the future. So if we see an upward sloping yield curve where the long-term rates are higher than the short-term rates, what that means is investors expect that somewhere in the future short-term rates are going to go up. So if they didn't expect that, if they expected short-term rates to go down, then they would be willing to buy short-term debt right now and catch the bigger returns that they've got at the moment. So basically, it just argues that if short-term rates are accurately forecast, or if they're being accurate, they don't only have to be accurately forecast. If short-term rates are being forecast in the future, people are going to make decisions based upon sort of the average short-term rate over time. They're willing to borrow long-term if the long-term rates are less than that average over time. They're going to borrow short-term if the long-term rates are high, if the short-term rates are lower over time than that long-term rate. So basically, they're going to just find the cheapest form of financing over the long term, and so the long-term rate is just a average, in essence, of all the short-term rates that are expected in the future. We're going to have a problem that addresses this in this chapter as well. One of the issues that comes up in making a decision as to whether to borrow short-term or long-term is that, in fact, short-term rates are a little less stable. They move around more. So if you're borrowing short-term, you can't always count on the short-term rates staying where they are. We see here the relative, the interest rates on really two different kinds of debt. These are both, in this case, commercial debt. We see in blue here, that blue line is the interest rate on AAA rated corporate bonds, which is the highest rated bond, corporate bond that you can have. And in red, on 3-month commercial paper, which is only available to very high quality corporate borrowers. And the main thing to take from this is the black line is just the consumer price index, which you see that interest rates are higher when inflation is higher. That black line is the inflation rate, or a measure of inflation. But the thing to observe here is that red line bounces around more than the blue line. The red line is short-term debt costs. Sometimes the short-term debt costs are very high, higher than the long-term. Other times they're very low, but in general, short-term debt is more volatile. The rates are more volatile. So if you borrow short-term, you're taking on some risk that next year the interest rates are going to change, and if you're borrowing short-term, they may change more for you than they would for a long-term borrower who's going to have lesser changes in rates over time. There's more certainty, more security as to what the refinancing costs are going to be for those long-term borrowers.